Welcome back. Now, Gauteng Finance MEC Jacob Mamabolo has stressed that the province needs to focus on raising more money in preparation for tougher economic times ahead. He made the remarks as he was tabling the midterm budget policy statements for the province. Mamabolo also highlighted that the province is working on a plan to settle its e-toll debt and will submit a proposal to the national government next month. I did catch up with the MEC and others who were at the legislature when the MTBPS was tabled. Take a look. Gauteng remains the economic powerhouse for South Africa, contributing just over a third to GDP, making how it spends its money vital for economic growth. For the 2023-24 financial year, the province managed to add 4.5 billion rand to the kitty, bringing the total budget to just over 163 billion rand.
Whilst there's a big problem about cuts and so on, we believe we must raise money. We believe our effort must be on finding revenue. Because moving forward is going to be tough. Just in the next MTF cycle, 2024 MTF cycle, you're going to see severe cuts in the budget. It's going to be difficult for provinces. So we are saying, in anticipation of that, if there's one thing as the provincial government we can do and as treasury we can do for the province, is now to look at raising revenue.
A major pain point to the province's economic growth strategy is the energy crisis. And to that end, the province entered a memorandum of understanding with City Power about 2 months ago and is now fast-tracking implementation.
We are effectively an implementation agent for the Gauteng province to deal with the limitations of energy problems that are happening in and around the province. So the MOU covers, in essence, the replacement of transformers that have long been out in different townships. It also covers the replacement of meters and putting in new technology of smart meters, as well as public lighting, solar high masts that will work even if there is load shedding. And we will also be looking at doing generation projects that will be adding more megawatts onto the grid.
The MEC of Finance also highlighted the province's plans for a state bank as well as a pharmaceutical company. But this was met with much criticism from the DA that called this nothing but a pipe dream.
If you listen to what he said today, he's saying they're going to use another bank to have an account there and then use that account to then do what needs to be done. Then why don't you just continue using the same system that is currently there for you to then want to then institute or have another account in a bank? I don't know what is the real purpose for that. Lastly, I want to then say that he's talking about the pharmaceutical company. But nobody's even telling us, are these people going to be manufacturing, the drugs that are needed? Or is this now going to be another middleman that is now being created, which is again going to defeat the whole purpose of why we're having this? Because if you have a middleman who wants to then add his own, percentage to whatever the cost will be, then it defeats the whole purpose of ensuring that you have medication quick enough, that you have medication that is, cheap enough for people to then be able to then afford.
Let's take a look now at business news making headlines in the week that was. Steel producer ArcelorMittal South Africa says it may be forced to let go of 3,500 workers at its Vereeniging and Newcastle plants because of lower demand and the country's structural issues. The steelmaker has been grappling with a 20% fall in demand over the last 7 years, caused by low growth, strained infrastructure spend, and various project delays. Its issues have been compounded by load shedding, rail service failures, and higher logistics cost. ArcelorMittal will engage unions on the possible closures and says it will try to lower the number of jobs that could be affected. The firm dropped to 448 million rand loss in the interim period to June this year, a drastic collapse from the 3 billion rand profits reported in 2022. Bidvest Group says its consumer-facing units suffered as local household spending was more constrained by the cost of living. The group's performance was muted during the first 4 months for the full year of 2024. Bidvest, which has held its annual AGM, says revenue growth slowed, hit by lower activity, volume reduction, and price competitiveness. Bidvest owns vehicle seller Bidvest McCarthy and medicine maker Adcock Ingram. In October, the company successfully raised 1.4 billion rand in the domestic bond markets to replace existing maturing contracts. During the year, it was able to acquire hygiene services businesses in Singapore, the UK, Ireland, and Australia. The company's share was down nearly 10% on the news.
An update for the group's first 4 months of the financial year, which ended at the end of October, so 31st of October. It shows two muted performance for the first 4 months of what would be the FY24 financial year. The expected slowdown was signaled previously, but we actually saw volume and margin drops, particularly in the consumer-facing activities, which, according to Mpumi Madisa, who's the Bidvest chief executive, was actually greater than anticipated. So overall, our revenue growth slowed. Activity did actually come off a high base, but was diluted by contracting durable consumer spending, volume reduction in some sectors, as I've highlighted, and also, interestingly, increased price competitiveness. Travel and hospitality also saw some growth, but there was some gross margin pressure.
Tiger Brand says it was forced to pass on higher prices to its customers to keep up with steep operational costs. The country's largest food producer says it inflated products by 11%, which helped it to raise its revenue by 10% to 37 billion rand. The company says the results are reflective of the challenging trading environment marked by high food inflation, cautious consumers, a weaker local currency, and Eskom's load shedding. For the year ending in September, Tiger Brands reported a mere 2% increase in headline earnings per share. Group operating income came in lower by 9% to 3.1 billion rand.
That's the biggest food producer in South Africa. I mean, already they're reporting a 2% rise in annual profits. I mean, it's been supported by better than expected growth in income from some of their subsidiaries. I mean, already their total revenue increasing by 10% to around 37.4 billion rand. That's been driven by price hikes of around 11%. They've also had some favorable FX gains of around 1%, and also, we've seen their volumes decline slightly, but the results there are really reflective of the challenging trading environment that has obviously been marked by high inflation. Consumers who really are cost conscious at this point in time. You've also seen a weaker rand and also unreliable electricity supply playing into their trading environment. Now, despite the double-digit inflation across their portfolio, we did see that the impact of their group's volumes was quite minimal.
And Quantum Foods has joined the long list of chicken producers counting the losses caused by the South Africa's worst bird flu outbreak. The company says losses for the reporting period hit 35 million rand. Last year, Quantum recorded 37 million rand in profits. Quantum says it culled layer hens and breeding stock worth 155 million rand during the financial year due to the bird flu outbreak. Making matters worse was the extra spending on securing power during bouts of load shedding. The company spent some 35 million rand on generators and another 52 million on diesel that runs them.
We've had a loss of 35 million. A couple of things affecting the power cuts. Of course, the way chickens are made, for those that don't know, it's not like, they're out there in the garden somewhere and you just throw a bunch of millies at them. They are in these farms, these kind of like big buildings with controlled air, controlled lighting, controlled feed, and they transform an egg into like a chicken in an unbelievably short amount of time. The number of days, 1 day or 2 days, by the time the chick comes into the time it basically can be slaughtered, makes a huge difference in profitability. So this is a very well-timed industrial process. So power cuts affect them. They've also been affected obviously by the bird flu situation. So they made a loss this time around from a profit. So the 35 million loss this time. Last time was a 37 million rand profit. So it is a negative turnaround for them. And obviously, we've talked about it before. This affects obviously food supply in the country and makes the cost of poultry products more expensive.
SPAR's operating profits almost halved to 1.8 billion rand. The distributor lost money as a result of poor software rollouts in KwaZulu-Natal and lower sales volumes in its local operation. Non-recurring items accounted for 1.4 billion rand of the 1.6 billion rand drop in earnings, indicating that earnings may improve in the 2024 fiscal year, when impairments or write-downs on books are included in its earnings after tax fell from 2.2 billion rand to 979 million rand in South Africa. It reported an operational profit of 1.2 billion rand, over a 50% decrease year on year. The business added that it will not roll out software to other provinces until the KwaZulu-Natal SAP system is reliable. The company is losing money in its wholesale business in Poland, and sales are also dropping in Switzerland.
Or by 10%, but this also indicates the challenging environment for consumers, and from all the reasons that we know, high inflation, high interest rates, high unemployment. And yes, the guys managed to open 79 new stores, but the guys, they've got this big issue when it comes to the KZN distribution center. They tried to implement a SAP, so that considers the losses for them, not just for the region but also for the group as well. But the good thing is that some of those losses that they've seen are the ones that impacted profits. 1.4 billion thereof are non-recurring, and unfortunately their operating profit is down 46%, just like their profit as headline earnings per share down 46%. Hence, it's not surprising that they are not paying us any dividend.
Welcome back. Let's continue taking a look at company results out in the week that was. Ntokozo reported a 5.86 billion rand profit for the 6 months ended 30 September 2023. The hotel and entertainment company recorded a slight increase of just over 5 million rand. The total revenue was 5.85 million rand. In the period under review, net income was 896 million rand.
For Ntokozo, the result was actually pretty solid. We saw good revenue growth, as you mentioned, and it really was broad-based from the casinos to food and beverage as well as entertainment as well. We did see some strain on profitability though, and that is mainly because of higher inflation, the impact of load shedding and diesel expenditure that it has to occur in order to keep the lights on, and a host of other issues. None of this was insurmountable though, and I think that when you look at the company's outlook statement, it was actually pretty positive. So I think that's a decent set of results from Ntokozo, now showing a more normalized kind of framework after a very strong recovery after COVID-19 that we saw play out last year.
And in its results for the 6 months ending September 30, Lewis reported greater credit and fewer cash transactions. The retailer expects consumer spending to remain low in the near future due to rising economic challenges such as load shedding and port congestion. The group also anticipates that loan demand will remain strong. The business reported that its debtors book increased by just over 10%, credit sales increased by 19.5%, and cash sales decreased Total income from the various brands climbed 8.3% to 3.8 billion rand, including Bears, UFO, The Best Home and Electric. Operating profits increased 7.5% to 309.3 million rand. Lotus profit fell 6.2%, while headline earnings per share, a standard profits indicator in South Africa, fell by the same margin.
A very clear indication that consumers are struggling, all because of this high cost of living. Because now, if you see credit sales going up by almost 19.5%, and now cash sales going down by 14.4%, and the very same credit sales now accounting for almost 64.4% of their total sales, before it used to be 56% or so. That indicates that people don't have money, they can just rely on credit, and you look at the likes of the UFO, which is more of a cash business for them, that their performance was weak because people cannot get credit from that end. Yes, they did manage to open 29 new stores. We've seen that total sales were up around 4.8%, revenue up around 8.3%. But look at their profits as headline earnings per share, down 6.6%, and the interim dividend was increased by mere 2.6%. And they still have challenges going forward because of the port issues, that they might not be able to get whatever stock they need. And the new product range managed to help them, and strong advertising helped them as well.
And Naspers announced a 112% increase in half-year earnings due to improved performance by its e-commerce operations. For the 6 months ending September 30, 2023, the technology investor reported that core headline earnings per share increased to 454 US cents. Naspers reported a $38 million e-commerce trade loss, down from a $270 million loss. Revenue from operating or ongoing operations increased 14% to $3 billion US, with ads, food delivery, payments and fintech contributing the most.
Those are significantly more improved than what we saw the previous set of numbers looking like. We know that Naspers has gone through quite a bit of changes with CEO changes, as well as their share repurchase program that is still an ongoing program. They gave a bit of guidance around that. That's doing well for them. The OLX Autos business, if you remember, they had that business. They sold that business, declassified that business unit, and that's also come off their books. So they've given us a bit of a detailed overview of the performance. Revenues are up, earnings per share is up, headline earnings per share, most importantly, is up quite significantly, as well as core headline earnings per share almost more than doubling over the period. So if we look at this half of the year versus the first half of last year, it is significant improvements, and we're hoping that this is a better performance for them when they wrap up the second half of the year and we get full year results. So the business is looking like it's turning around, and they're making some good strategic decisions to get it back on track.
Well, in some international news now, and I know ladies who have full carts on Shaheen, the rumor mill is rife with news that the retailer has filed for an initial public offering in the United States, and it's planned for next year. The online retailer is said to be working with Goldman Sachs Group, JP Morgan Chase and Co. and Morgan Stanley to get on that listing. The filing was reported earlier by the Shanghai Security News.
And they've filed confidentially with U.S. regulators for initial public offering that could take place next year. The online retailer, just to give some background, was founded in China. It's now headquartered in Singapore, and is currently working with a host of banks on the listing. They are hoping for a valuation of as much as $90 billion in a U.S. IPO offering. But at the same time, they have come under fire for poor labor conditions in factories that they partner with regards to overproduction of the quality of garments that they use, and the use of cotton from regions that have been accused of certain labor practices. So a very interesting one to look at.
An energy business located in the United Kingdom will purchase a 36% share in Sasol and Total Energy's Natref oil refinery. The Prox Group announced that it had signed a sales and purchase agreement for just more than a third of a share in the company. The deal is contingent upon usual authorizations, consents and approvals. The Natref refinery, situated in Sasolburg in the Free State, has a daily capacity of 108,500 barrels of oil. It provides Johannesburg and the surrounding areas, which is the primary inland markets in South Africa.
It's a positive here. The group is called the Prax Group, I don't see the exact numbers at the moment here, and apparently they're still waiting, authorization from the authorities and so on. And I do think that this is obviously a good sign. We actually had a real issue recently where our refining capacity in South Africa has come down, significantly, to say the least. I mean, what's happening in places like the Durban refinery and so on. And if we don't, find some kind of solution to this year, it's going to be a real problem for the country. I mean, we can't be. There's many countries out there, especially like places like Nigeria, that make oil. We don't even make oil, but make oil, ship it across, and import refined goods. You know what I mean? Refined products. We don't want to be in a situation where we have to import refined products, because not only does it mean that we're more vulnerable to international forces, but it also means that the activity that would have occurred in this country will go elsewhere.
The African Development Bank has reduced its GDP projections for the continent. According to the bank, Africa's growth will stall this year and only potentially rebound in 2024. GDP growth is expected to slow to 3.4% this year before rebounding to 3.8% in 2024. Political insecurity, slow global development and high interest rates are wreaking havoc on the African continent. It's predicted in May that the GDP will rise by 4% in 2023 and 4.3% in 2024, following a 3.8% increase in 2022. The AFDB reduced its 2023 growth predictions for Central Africa to 4.1%, citing a coup in Gabon and ongoing conflict in Eastern Democratic Republic of Congo. East Africa's growth estimate has been reduced to 3.4%, putting Kenya under pressure to repay or refinance a $2 billion loan due in June 2024. Southern Africa is expected to have the continent's lowest growth rate in 2023 at 1.6%, as periodic power outages limit output.
So I think the African Development Bank expects a little bit of a dip this year before a small recovery next year. Remember, most of these African economies are exporters, either of commodities or unfinished goods, and global demand has generally been weak. The governments are also highly indebted following all the spending people needed to do in COVID, and because they've been unable to export, have also been unable to pay down this debt. And then global interest rates have been quite high, and I think a lot of these central banks also follow the global trend. So there's also soft demand there. So and remember, the Ukraine wars complicated everything around food inflation, and that impacts a lot of these countries. So I think that's the driver of the weaker growth outlook. It probably will continue for a little bit longer than they expect, but that's the environment that these governments have to deal with for the short to medium term.
Well, we've come to the end of this week's business wrap, and with December around the corner, it means more and more people are starting to put away their laptops in preparation for the holiday season. But there's still some business on the go. Let's take a quick look at what we have on the business diary this week. And of course, with climate change, the issue there, it's not just a distant phenomenon that only impacts the well-heeled nations and the upper class, but it hits home and right on your pockets, taking the little taxes that we pay to fix what Mother Nature has damaged. So while my colleague Zianda is in Dubai for COP28, we'll tell you the cost of climate change in South Africa and also get an update on the country's green hydrogen commercialization strategy from DTIC Minister Ibrahim Patel. So a lot on the go. We'll also have GDP numbers out that will be digging into the final numbers for the third quarter of the year that will give us an indication of what the economy will be looking like going into next year. So quite a lot on the go in this coming week with results as well. Dumisang Glovu will be with you on the AM report tomorrow at 6 a.m. That's all from me this afternoon. It's goodbye for now.